You already know what Linklaters is about. It's a law firm, and I'm a real estate partner here, based in Frankfurt and Munich. And actually, except this morning, I have to run after this panel because it is the second busiest week in my entire career. It is. I had a week like this in June 2007 when I was reasonably younger, and I don't know whether I can do it in 10 years. But this week is still possible, and maybe until Christmas as well, but certainly not between the years. So if you need me, then call me, and I'm happy to help, but only until Christmas. It is due to certain situations in the markets. I mean, we were in the process of selling the nice buildings with the cranes just next door, and other big blocks and stuff. So it is a very, very busy market. It is extremely busy due to the real estate transfer tax reform. And what drives me this week is that people expect the finance ministers of the German Länder to come up with a proposal for the VAT reform on Thursday. And if you're a bit negative, and some of the big four are a bit negative, they say, I'm not as optimistic as I am, I would say that the law comes in place next year or even later. But if you're a bit skeptical, you would say, okay, that might be the first day the new regime hits in. So people actually try to close their transactions, meaning transfer their shares by Thursday. One client even tries to be faster than the possible release in the afternoons we are trying to close Thursday morning. So this is what drives the market. It is a very good market. It's a bit hot. It's a bit overheated in my eyes, because I know Thomas' sentiment, but when I was that busy in 2007, we were closer to the end of the cycle at least. So at least be cautious if you start seeing crazy things. And then I stopped. Another thing that might have to be closed prior to Christmas comes in with a down payment or first rate for a developer of several million, basically from the investor. No letting, no building, no nothing. And again, I'm now searching, because I have to draft it, I'm searching for old samples that I still have out of the years prior to 2010. So I see some signs for the market to overheat, so be at least a bit cautious. We will come to it. I'm optimistic as well, but be cautious.
Okay, good. Martin, are you just give us a brief introduction, and are you optimistic as well?
Well, a way of introduction, my name is Martin Shiller, and I'm responsible for acquisitions and sales within Union Investment, responsible for Europe, mainly for offices, because we have specialized departments for retail as well as hospitality investments. I think most people in this room will know who Union Investment are. We are the investment management arm of the cooperative banking sector here in Germany. So with a 50-year history of growing the portfolio, I mean growing it in most years. I can only remember 1 year where we have been a net seller. That was luckily in 2007, when just before Lehman, we sold big portfolios of value-add opportunities to Anglo-Saxon and German investors. I think that's been a good timing in hindsight. We weren't, let's say, a forced seller back then, but had to be a very willing seller due to the crisis of confidence we had in the sector of open-ended funds here in Germany. But I think ever since we've grown the portfolio again and invest typically between 2.5 to 5 billion a year globally, and the portfolio is now up to 35 billion in 22 countries around the world. I think we invested quite heavily and expanded our exposure in the US over the past couple of years, but with the hike of the rates there and hedging costs which have come up quite a bit, we find it difficult to continue investing in the US. So we again concentrate on Europe and mainly on offices, I would say, in hubs of Europe where we see continued rental growth. I mean, there are some economies which are clearly lagging behind, and some will continue to perform better than the average across the EU. We take France, for instance, where the economy has a good room to grow, and some have really to catch up, like the Finnish economy. It's been lagging behind. So I think we concentrate on markets where we see a lot of potential, and that includes the big five here in Germany, for sure. Where did we invest this year? In Stockholm, we invested in Helsinki, but we also invested in Frankfurt. Bought one of the towers in the 4 project, which was mentioned earlier. So yeah, we're trying to seize opportunities here across all sectors of commercial real estate, and Germany will continue to be of main importance because the majority of our funds center their activities on Germany, or they exclusively only invest in Germany. So we have a real pressure to invest here. We are obviously comparing our home market to other markets across Europe, and we still see a lot of potential here. Yeah? It's all about supply-led growth. Yeah? Undersupplied office markets with a healthy demand going forward. That is our main topic these days.
Okay, good. Markus.
My name is Markus Beran. I'm having the origination department for Berlin Hyp for international investors, meaning all international money coming to Germany, looking for opportunities to buy and looking for senior debt, and that's basically our product. Then they're with me and my team. We are, as Berlin Hyp, part of the savings bank sector. Savings banks are 100% of our owners. A lot of discussions in the banking sector going on, consolidation. You see the Landesbank discussion going on. So it's interesting times there. Oversupply in banking as well, a lot of competition out there. So it's quite challenging on that side. What concerns the real estate market, it's not so much new. Last year, this year, next year, the outlook, I wonder that everybody's waiting for something extraordinary to happen. So far, not the case. Despite all the French elections and American elections, whatever we had the last years on discussion, nothing big has really impacted the market so far. And we as a bank are usually not the drivers, but we are on the back seat and following those investments and see whether we want to be part of that or sit in that car driving along or not. We can be there quite selective in the time, and so far we have done, I think, relatively good.
Okay, great. Daniel.
Daniel Werth. I'm a managing director with MOMENI. As mentioned before, we are a development and investment management company. We're based in Hamburg. We've been founded in 2004. Ever since, we have invested around 4.5 billion euros throughout Germany, with a focus on office and retail only. We're not investing into anything else. So currently, I guess we're profiting on the development side in terms of selling product. As I just mentioned, we sold Axel Springer transaction you saw on Thomas' slide. On the investment management side, it's obviously a bit more complicated. We're a value-add investor, saying like we're investing into office to basically refurbish and modernize office throughout Germany. We've been quite active in the North Rhine-Westphalia region. So basically, I feel extremely comfortable with the slides Thomas presented in terms of our investment strategy. We're 35 people. 2 offices, main office is Hamburg, we have an office in Düsseldorf.
Great, Karsten.
Yeah, I'm Karsten Kohlmann, managing partner of Waterway Investments. We are a transaction advisor and capital solutions provider working in the German markets. We're a big fan of all those secondary markets that Thomas doesn't like. We do everything outside of the CBDs of the big 5 cities. We love the Karlsruhes of this world, and that's our mantra to a degree. We're also a capital solutions provider where we tap international capital, give international capital in hand. When it comes to investing in Germany, we explain the German markets to international investors, and they come from Australia, Middle East, all over the place. We work from Frankfurt and London, work that bridge to a degree. And as I said, usually you won't find us selling the big office towers in Frankfurt, but anything else all across the country, from north to south, east to west, commercial real estate mainly. Yeah.
Okay, good.
Richard, can I add maybe something I forgot? Because I was giving him so much props, basically, for his presentation.
It's not another name change, is it?
No, it's not a name change. It's even more dramatic. Basically, I'm born in Hanover, and when I saw your slide on the risk-return profile, I saw that Hanover was pretty much like the lowest. Sorry, pretty much actually having like the lowest return perspective while having the lowest risk. Is that like what's the reason for that?
Maybe we can flip to the slide, please.
It was slide 10 actually.
No. It seems like there is one guy here listening what I'm saying. This one, yeah. You can see it here. No, this is the Catella risk model. Don't discuss that. It's our risk model, and this is, of course, the cross-prime yield. Highlighting this, you see the turnover is under 4.5%. So it's close to Düsseldorf and Cologne. Just if you highlight this, bring it over, make it more relaxed for reading, then it's okay. I love hello. Thank you.
Good. Right. Let me just bring us back up to date. Maybe Martin. Thomas actually mentioned there that, let's get back to the fundamentals. Let's focus on those. So why don't we do that? We've got GDP growth. Interestingly, I had one session, which is the first time in 2 years, which was about a month ago, where Brexit wasn't mentioned at all in the whole session, which was extraordinary. So I was delighted when Ansgar brought it in as the third word that he mentioned in the introduction. So putting those kind of risk factors aside, looking at GDP growth, looking at, you've got higher employment. How do you see those fundamentals playing into, I suppose, your investment strategy, particularly looking at Europe, where you're active, but also at Germany?
I think we are mainly concentrating now on these markets where we see continued expansion of the economy. I think France is certainly lagging behind Germany, for sure. The Netherlands is an outperformer, like the Irish economy with Dublin. So these are cities, take Amsterdam, Dublin, or take Stockholm, for instance, where rents have been growing for almost 15 years now, continuously, with just a little bump due to the financial crisis. And they're now nearing levels we see in the City of London, and are in excess of rent levels here in Frankfurt. So I think that clearly shows that it's back to the fundamentals, because rates will rise, and we'll need to compensate that with additional rental income. And from offices, I think that is going to happen in a couple of places. I mentioned Stockholm, Amsterdam, Berlin, certainly Munich is one of these places. Wherever vacancy rates are down to a level where a supply-led growth, just due to a lack of product, will materialize in rents, which might even exceed some people's expectations. Like take Berlin. I think international capital is looking at Berlin differently than we Germans do, because we have long memories and we've seen different times, and we've seen a German crisis, homemade crisis, coinciding with the dot-com bubble bursting, and we've seen terrible times for Berlin. But outsiders who now look at it, first-timers from abroad, they will see it as the one emerging TMT hub in Germany. And if you think that TMT is going to be the most dynamic sector moving forward, if you look at the occupier base, there's certainly some credits for Berlin in that perspective.
Okay, good. I wanted to pick up a little bit, and anybody else feel free to come in on any of these points. Karsten, you're also seeing international capital looking particularly at the German market, but you'll also be getting feedback through from your other teams around the world. What's your sense at the moment of the political risk when you're looking at it? It's been a topic of conversation for the last certainly 2 years. But in general, it seems that real estate doesn't get too badly affected by it. So let's pick up on some of the things that you're seeing at the moment in terms of political risk. Do you think, for example, there's a lot of stories that have been written up about the fact that Merkel will be leaving and the hole that will leave in Germany? What's your sense of these things?
I mean, I think the most important thing is that the real estate world, as probably the word itself, changed dramatically over the last, and you saw it in one of Thomas' slides, 20 and 10, even 10 years. So it is a global market, and it doesn't really depend on, I mean, these sources of capital are so big, they need to constantly invest. So it doesn't really help them to look from Asia or the Middle East or the US to Merkel. I mean, they don't know who that is. And frankly, they do not care. So they constantly need to invest. So I think, I mean, that is completely dislocated from political risks. And what else can come? I mean, the Americans voted for Trump, and they will probably vote for him again. And Brexit happened, or whatever. So we survived certain things, and compared to that, Miss Merkel leaving is a normal process. We had different chancellors before. I think she stayed a bit too long, but it's still okay for her to leave. So it is. We need to kind of give her credit, because most of them you have to take them out. They don't see the point when they can leave. She at least realized it. A bit late, but it's difficult to kind of realize it earlier if you're in such a position. So I think won't be a drama. We have more parties now in the parliament. They still will have a government. So I don't see that being a risk. The GDP not either. So it is more allocating capital globally, and then we need to work with the asset. I think that's what drives the industry much more than anything else.
Okay, good. Yeah, Daniel, yeah.
I think there's some risk basically coming from, I'm not sure how you see it, but basically from economic policy. Basically, if I look at Donald Trump and the trade war basically that he's starting with China, that reflects back to economy in Germany, doesn't it? Reflecting then back to the office sector as well.
Okay, good. Just with you, Markus, let's look at the other risks. Do you see things like interest rate risk? I mean, Thomas looked at that positively in a way. That how do you see that? I mean, there's going to be there's already some unwinding of QE, for example. How much influence do you think the interest rate rise, if there is one, could potentially have? Is that a big influence or not?
Well, the aim actually is to have kind of a soft landing or make it as smooth as possible, because on one hand you have the inflation in investment, you have a lot of liquidity in the market. On the other hand, you have governments or countries like Italy heavily depending on low interest rate, and they have to balance that out on the particular arena. And if nothing dramatically impacts that from the outside, that will be a smooth landing. They will gradually and slowly increase that to an extent, to maybe take a bit of liquidity out of the market, but not in a big shot. They cannot afford it, basically. And what we make out of that, we underwrite transactions only in a way that we make sure that after a low maturity, the projected income is sufficient to also serve a higher debt yield than maybe going in. So we structure that in a way. But again, that's not something which happens tomorrow. With them, our loans are 5 to 7 years, 10 years in the future. So we need to factor in that the interest rate environment by then may be very different than it is today. But on the short term, we don't see a big change.
Okay, good. And I just wanted to pick up the Brexit point, and anybody can pick this up. How kind of tangible? I mean, we saw there from Ansgar's introduction at the beginning that there's more jobs being created here, there's more people moving here. How much of that is sort of Brexit related, where there are potentially companies moving into Frankfurt? How much is it is just natural growth from within Germany? What's your sense of that, anybody?
You mean from within Germany?
Yeah, whether this is because there's a strong economy, so therefore the fact that there are new office building going up here, that you've got an increased number of people moving into the city, increased jobs created. Is that partly to do with Brexit and jobs moving from the UK over to Germany, or is it just a fact of the strong growth within Germany itself?
I've just read a Hellerbar report actually, for that.
Same
Report basically where they analyzed this basically and coming to the conclusion that about 8,000 jobs would be potentially being transferred into Frankfurt, resulting into over 100,000 square meters of additional office demand. If that was true, I think that would be obviously be quite a positive effect on Frankfurt, I guess. But I guess it's Frankfurt and Berlin. I guess it's not really Hamburg or Düsseldorf or Cologne.
But I think, if I may say something to that, if you look at the financial sector, I don't think that the occupier market in this city has seen much of a Brexit effect. There's been a Brexit hype around Frankfurt on the investment market, but the occupier base has not grown a lot. I mean, some people have moved personnel from London, like Goldman did, but it's not a big effect. What we're seeing in Frankfurt, I guess, is more like the end of a long consolidation period, which lasted 15 years of job cuts, of absorbing vacancy in the office market, which has now come to a turning point. But I think it's more a homemade growth, really, that comes mainly out of the German economy. Whilst other places, I think Dublin's been a lot more affected by Brexit, because it's a much smaller market.
Okay, good.
I agree. I mean, Frankfurt is my second home, but Frankfurt is not London, and it will never be. So Berlin could possibly be. You look at the city. I mean, the sheer size and what is out there for people won't change it dramatically. So I first of all, I think Brexit won't happen. I mean, the deal is no Brexit. So it certainly has no impact on the financial centre, and the government can't in the UK can't be stupid enough to not see that the financial industry in London is their powerhouse, and to give it away would be so stupid that no government in the world is so stupid. So it will remain the centre for the financial world. If we have some more office space here or there, that's nice, but it won't change dramatically in my eyes.
Are you going to say don't underestimate the capacity of the British government to be stupid?
No, but I mean that was a good point, because Brexit hasn't happened yet, right? So I mean we're discussing about what's going to happen maybe, or which companies have moved people over, but nothing has happened. And if you read up, I mean I've been living in the UK for 12 years, and you read the news there, the British don't know what's going to happen either, right? So there are like 3-4 scenarios that are being discussed, and just read this morning that the deal that's on the table will cost the UK 40 billion, but a no Brexit deal, the Treasury is just calculating their estimate why it might cost 150 billion. So kind of that's all ammunition that's being put together, but it might not happen in a way that we see it happen, or it might not happen at all. So hence we don't see any consequences yet, right? I mean, okay, a few investment bankers moving over, a few banks having contingency plans, but the real effect, if a real Brexit happens, will be felt like in the years to come, and then we can have that discussion next year, what is happening in Frankfurt. Yeah.
And despite any like fundamental arguments, like I've read, I'm always failing this in that context, I've read like an interview with a hedge fund manager living in London, and he was asked about Brexit basically and relocating plans, and he said like he would rather live on a graveyard in New York than in Frankfurt. So I guess that's something
that's a bit too harsh.
Yeah,
Careful now.
I'm just quoting. It was
It's the guy from the city. He just left.
It was.
Fortunately, Ascar has left. Yeah, so that's.
It wasn't me, but basically there's a component to it. I guess like you have to get a potential to relocate. There might be good arguments, but basically if people don't want to come, that's another argument maybe.
And
Is it really only up to those people who want or don't want? If the European Central Bank all of a sudden decides to do certain measurements and saying if you have to trade, you cannot have it in London, you have it onshore where the Eurozone is, that might impact the industry there as well. I mean, I'm with you that London will always be the major financial center in Europe, because they have just the entire infrastructure, the entire talent, whatever is created there, nobody can repeat that. On the other hand, the impact this Brexit decision and not knowing what they really want. Do they want out? Do they want in? Now Scotland is asking what is costing if we decide not to leave at all. Is that all possible? So this entire discussion is just uncertainty, and it postpones the investment decision, but doesn't really call them off.
And has that happened with you, Martin? Because obviously you're investing across Europe and have invested heavily in the UK before. So Thomas's view was that uncertainty, again, like yours, Markus, is actually postponing things. Is that the position for you? Are you looking at it differently? Are you, on hold presumably until the 30th?
Until the 11th of December, at least.
Yeah.
But we would be stupid if we weren't looking at opportunities. Because around the time of the Brexit vote, we've seen a market correction, even though it was a short time, and we've seen a discount in pricing. And now obviously we're looking closely at opportunities to see if that will happen again. Times of uncertainty in a cyclical market like London may create opportunities for us, but we will certainly, we are on hold until further notice or until we see a market correction, which we need to see because rates have moved up, hedging costs have moved up for us, so our cost of capital for the UK between equity and debt has increased by 75 basis points compared to where we were when we made our last investments in the UK about a year ago. So I think that needs to be reflected in higher yields, which we hope to see. I don't know whether we're going to see them in the short term, but we will definitely always look at London as an investment destination. We have to.
Okay, good. I wanted to pick up a little bit on the sources of capital and also what you were seeing from there. Karsten, from your side, looking particularly at the areas that you're looking at in Germany, are you seeing new, different types of capital wanting to actively invest in the sort of CED, smaller locations, more value-add side within Germany?
Well, I think definitely, right? The market has changed significantly over the last 5 years, and also I would say compared to the last cycle where you probably had a few investors from the Irish background or similar countries invest in Germany, whereas now we see, we just see it in our processes, right? Where 5 years ago we kind of probably had 3 hot contenders for a deal, and now it's like 10, 15, 20 contenders and parties from backgrounds that weren't around in the past, and obviously people are more educated, I would say. I think the German real estate market has developed quite significantly also in terms of professionalism in the last, in the new century, I would say, and that is kind of reflected in the investors coming to Germany, right? You see all those Asian investors coming, Americans, you see kind of the next level of investors, pension funds, whether it's via debt or direct investments coming to the German market. So many listed businesses, that Germany was never a country that had a lot of listed companies, but that is kind of growing, or parties that want to grow assets under management in general. So there are many, many different types of investors that we are dealing with, where we are happy about, right? Because there's a different type of competition, because everybody has a different motivation to buy a certain product. Whereas back in the day, it were kind of the 2-3 competitors that knew each other, probably picked up the phone to each other when kind of a deal was discussed. So we quite like it, and Germany is definitely. We spend a lot of time in London, talk to different parties, and Germany is still seen as a safe haven. And I can only agree with what Karsten said, right? Different discussions about political risk, etc. Other countries are off much worse than Germany at the moment, and if you see it on a global perspective, I think we are right up there at the moment. Yeah.
Okay, good. There's a couple of questions that have come in on Slido, so thank you for those. One is looking at where are we in the cycle. Interesting also to see that from the question also included where are we in the cycle in comparison to, let's say, the US. So it'd be good to try and pick up on that, and that's also related then to the yield for office. So if anybody wants to pick up in terms of the cycle where we see ourselves in, I guess in Europe versus the rest of the world, and also let's look particularly at Germany as well. So does anybody want to pick up Germany first, Daniel?
Germany, I think in terms of for instance, office fundamentals, I think we're still at the peak of the cycle. I don't think I don't see a slowdown in the next 2 years in terms of fundamentals. In terms of the investment market, I guess like we're in the late peak of the cycle, as Thomas mentioned in his chart or showed in his chart. But basically, in terms of office fundamentals, I'm very optimistic for the next 2 to 3 years.
Okay, good. Does anybody want to pick up Europe? You mentioned a little bit already, actually, Martin, about Germany, but what's your sense of where we are in Europe within the cycle?
I think we have to look at interest rates mainly to see where we are in the cycle. And if you look at we heard Donald Trump blaming the Fed over and over again for what they're doing at present. I believe they're doing the right thing. But Europe cannot foreseeably afford that. If you look at Italy and the situation the country is in, we are going to live in a low interest rate environment for many years to come. And this will mean that I don't think that the markets are going to correct heavily, but maybe gradually. On the long end, if you look at the 10-year financing conditions, things will change, I guess, over the next year. I don't know if you agree to that, but I think but that is not going to have an immediate effect on the market right now. There's too much money at hand, and Europe is looking attractive also from an international and overseas perspective.
Good. Yeah.
I just wanted to add quickly, I mean, when we talk about cycle, it's mainly office what we talk about, right? And I think the different asset classes have different backgrounds that are a bit independent of cycles, right? I mean, what's happening in the retail industry at the moment is not really driven by a real estate cycle. It's different dynamics backing that up. And then you have many new asset classes that weren't really around in the last cycle, right? You have all those student housing, micro-living, nursery homes, residential has a different kind of environment than it had back in the day, and all those logistics, urban logistics, right, industrial, etc., new asset classes that are driven by completely different parameters than kind of the real estate cycle or interest rate environment, right? I mean, that's probably mainly referring to office assets in the bigger cities, etc. That's right, but there are many other dynamics at play, and which can make us quite optimistic that it stays like that for a while, because there are different powers that work than just the interest rate environment in general. No?
Yeah, but are not these niche sectors a kind of impact out of a booming market, out of a peaking market? Because if you don't get any core product, you go to the niche market. If you don't get anything in Frankfurt, you go to Karlsruhe. If you don't get the right office, you take a student housing. It's just an impact of what is happening. A lot of liquidity in that market chasing for product, and you have to decide whether you will really afford to go to central London and buy, or go to Paris and buy for 3%, or whether you need a 5% and you need to find it elsewhere, this product. And that's all part of we see that as well. What I said before. Forward fundings, forward investments, buying shares today and have the billing delivered in 3 years' time, all kind of structures which are happening out there is an impact of a really heating and overheating market. And that's why we are on the top or maybe on the tipping point. But at the end, is that plateauing? Is where shall it go? Where else shall the people invest? So it's not really there, but we are really in a hot environment. That is for sure.
I mean, it's just a bigger play, as I said before. So yes, it can crash, but it needs to go up rapidly, because there is still this cash coming from pension funds and blah 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 globally. So there's only a few locations where you can basically invest. And I mean, we all are in the very center of that bubble. You know possibly 5 cities, and you know London and Paris better than you know Hanover. So it is, and we are in the very heart of it. And that's maybe, I mean, it's political things, but it's Brexit as well, because half or 2/3 of the populations were just left behind because there is a global market now. But for investment, it means it will always drive in like 10, 20 core locations globally. Even if you don't invest for 2 years, we need to invest the double in 3 years, so it will come back rapidly.
Okay, good. Let's pick up on just some of the, I mean, you mentioned it there, Karsten, in terms of themes for some of the sectors, some of which are operating differently. We've talked a little bit about the the student housing, those kinds of things, which were also overweight by Kitela, that kind of area. Let's have a little look at the retail, because you brought that up. Who's positive, who's negative on retail? There's been a lot of negativity in general in the market, although that's often been based around whether it's experience versus convenience, whether it's a dominant shopping centre where the yields don't seem to have changed so much versus smaller centres. What's happening, if anybody wants to pick up Germany, do, and if anybody wants to pick up Europe, do. Daniel, you're investing, aren't you, in some retail?
So we're focused on high street retail. So I guess like basically in terms of like the fundamentals and the quality of location, I'm still optimistic that there will be sufficient demand for highly frequented high street retail spaces. But I think the concept of retail is changing, and basically if I'm looking at my hometown besides Hanover, if you look at Hamburg, like Zalando has opened like a huge store in one of the best locations in Hamburg now. So basically, I guess a location that maybe like 5 years ago Louis Vuitton would have looked at. So I think the way retail works actually changes, and the demand side actually changes. But I think there will be demand for retail units in good locations and frequented locations. In terms of shopping centers, I can't argue basically because we're not investing into this.
Okay, good. And Markus, do you look at retail you've obviously got to assess if you're lending the relative risks between the different sectors. I suppose, what are you seeing? How are you pricing the risk for the different sectors?
Well, first of all, we assess whether we enter into that investment in the first place. So the senior loan is nothing than a co-investment into a structure, if you talk non-recourse stuff. So whether that is money well invested or not, and whether there's future in that kind of scheme, or whether there's a lot of risks involved. And if there's a regional shopping center, they have their justification why they're in the market. If it's high street retail, maybe the demand is changing, seeing Zalando, seeing Amazon opening by sudden stores, pop-up stores or whatever, different schemes which are happening, but those locations will always be the locations. And that's where we're quite confident. As soon as you tap that into secondary, you have to really closely look what the story is behind and if that has a future. That's what we try to assess, at least for the time period we are invested in that.
Okay, good.
I think I'm afraid that retail is the most punished asset class, most hated asset class by investors these days, but you really need to differentiate. I agree with you that high street retail in inner city locations will perform differently from shopping centers, even dominant shopping centers, because I think there's also a generational change going on. And if you want to create an out-of-town destination as a shopping center, you need to think harder. You need to think harder, even if it's inside the city limits, like Unibail will open a big scheme in Hamburg, but this is like a second city center for Hamburg. Do we really need that? I think that there's a big question mark around that, but I believe you need to differentiate, and if you can pick assets wisely in a correcting market at increased yields, it might still be a very good investment these days. I mean, it's hard to buy in a correcting market, and it's not just sentiment. The market is really correcting, and it needs to reinvent itself to a certain extent with new concepts, new attractions being created. But and that's going to take a while. But I don't think that retail is dead. It's just undergoing a big process of change.
I mean, so I did a couple of sessions at MAPIC, interestingly, and on the investment one, there was exactly that positive view that you've got to be able to, for the smaller centres, you've got to be able to put some asset management in, turnarounds. You may then want to head towards mixed use for some of it, for example, but that in general, it was one of the things I started out with, looking at what happened when Selfridges opened. And it was all about bringing retail to the masses for the first time and creating an experience. And it was uncanny how similar the discussions about changing retail to an experience where you have the best food, you have the best entertainment, and all of that was happening when Selfridges opened, and I'm sure the same was true here when the big stores opened here as well.
But I think that is, I mean, you buy in, I mean, retail was a no-brainer 10 years ago, even the little boxes that no one really needed. But these days you kind of invest into an operation basically, so you need to trust the operator that they can wisely operate, but it is exactly the same once we come into the other niches and asset classes. It's exactly the same for offices. It's just not done anymore that you build a house and just let the spaces somehow. So I think we're facing the same in all the markets.
So this is a fundamental change in terms of whether it's the guest, the shopper, the occupier of the office, they're all expecting a different service level.
Well, they get it because some of these WeWorks and whatever hop into the space and offer all of a sudden more than just the office. Shopping center, same thing. If you think 10, 20 years back, there were certain destinations with different brands. Today, I think every shopping center in Europe has basically the same set of tenants. There is no big diversity, and it's rather boring than refreshing. And if you have a new concept and try something else, that might attract people. And you need to do that. Otherwise, it doesn't matter if you go to Madrid or go to Helsinki, you find the same H&M store at the same corner left, right. Yeah. And here you need new concepts to revive that, to bring that experience back, and that happens to all the sectors.
I think, I mean, living in England, you already see the trend, and that's, I think, where investors get scared when it comes to the continent, that now opportunistic investors are out there again trying to invest in out-of-town shopping centers at 15% NOI yields, and a lot of insolvencies happened in the last few years, so it's a very competitive market, and I think that scares. I mean, that's kind of the sentiment that we felt a bit coming over to Germany, whereas in Germany it hasn't happened yet and might not happen to that degree, but in England that's definitely happening. But also talking about retail is quite diversified, right? You cannot really compare a little supermarket in a tiny town with a Westfield shopping center in London, where I disagree to what has been said before, because you can spend a day there and have a good time, and you can send your kids to Kidzania, and they now extended the shopping center, so it's quite.
Nobody's buying anything.
Not? I've bought there.
Nobody's shopping.
Really? I think it's still. I think Commerzreal is quite happy still with the investment, right? Or I don't know. I mean. Well, I think so, right? I mean, they just doubled the size of the whole thing, right? So it must be working to a degree. I mean, I completely agree, and at our home, kind of every day, 1 or 2 packages arrive with different things, and I'm not a shopper really, but many people are, and that's why the lifestyle component increases, the cinema, the food court, Kidzania, all that kind of stuff. So I think the lifestyle component of the shopping center increases, and yes, you have to be more creative, but the question is then, does that affect pricing, right? Because before you sell something at a 4 or 5% yield with a going concern basis, but you won't sell something at a 4% yield that somebody has to completely restructure and kick tenants out, bring new ones in, so that might be a bit of an issue. Yeah.
Probably one really has to kind of rethink the concept, especially shopping center. I mean, Thomas said it, I mean, it's now food anchored, but I mean, a food concept can be in the market for 2 years, 3 years, 4 years, and it's boring because no one eats the same steak every weekend. And then if you look at rent levels, I mean, it's not the good old media market there for 10 years, the high rent. So it's just not. So you need to rethink, but maybe it's possible. Why not if you have a good concept? Because you need to attract people, and I strongly believe that people and human beings are still social somewhat. I mean, they've done for thousands of years, so they want to meet at the market somehow. So if you create that, it works. If it doesn't, it doesn't work.
Let's just quickly look at logistics, for example, has been very high on everybody's lists. Views on that, that's obviously the other side of the investment coin in a way from retail. What's your sense of that? Do you think that's going to be consistently growing in terms of yields dropping, pricing increasing?
Well, logistics in general, like this out-of-town Amazon centers in the periphery, I'm not a big fan, to be honest. even though I won't make friends here on that, but you're working at 4 to 5% yields on something with a 15-year lease, and we all know that in the next 10 years, kind of the whole concept of logistics will probably change. So in 10 years' time, you sit there with a 5-year lease to Amazon, and they already built completely new logistic type of hubs, and that's not required anymore. So at those pricings, I'm not too optimistic, but everything that's close to the bigger cities, what you call urban logistics nowadays, I'm quite optimistic, especially if you look at rents in Germany at the moment or compare them with the rents in the UK. I think there's quite a room in terms of upside where you kind of sit somewhere in the Midlands and have rents of 7, 8, 9 pounds per square meter, whereas here you hang around your 5, 6 euros if you're good. And if you come closer to London, you even break through the 20 pound kind of barrier. So I think there's quite a bit of room still, because at the end of the day, Amazon will transact there like transacts here. So I think quite like that market, but the proper out of town logistics type assets, I think they will probably change quite a bit in the next 15 years, and that could be a challenge at the current pricing. But I'm happy to hear the core investors' view on that. Yeah.
Okay, anybody else want to pick that up?
Well, I think you have to differentiate between markets, between countries, and if you look at Germany, there's not much buildable land for logistics. I mean, land is becoming increasingly scarce, and I agree that new product will emerge out of this constrained market, 2-story logistics, 3-story logistics, as we've seen in Japan, but still logistics, the land to develop logistics properties is very scarce amongst German communities, and I think we have a mainly German portfolio which we've built over 10 years, and we're now going through the reletting cycle, and the investments are performing very well on reletting because we invest very little money. We see increasing rents for logistics properties. There is literally no vacancy. If we lose a tenant, we replace it by another one. So for Germany, I'd be very positive, but that might not let's say, be the same situation in every country. It's much depending on zoning laws, on availability of land, basically, in the right locations.
And I think what we've seen and I advise Blackstone on the building up of logic, what we've seen in the logistics market is maybe an extreme, but it's a good example for what might happen in the other markets as well. That a couple of players are super important now. But they are now organizations. They operate, so it's more than just these even uglier boxes than the shopping boxes. But they operate. They have a company. There's an idea, a business idea behind, and that is the leverage. Actually, you can nicely play in real estate if you can create a size that matters.
Okay, good. There's a whole. We could have done an entire day on a lot of these on a lot of these topics. Just quickly, last thing, I got a question here about Berlin, whether or not it should actually have a different risk-adjusted prime yield in contrast to the other German cities, since the dominating occupiers are still in the red as tech companies or prop startups. What's the sense of that?
I don't see it for that reason, but I see it for the reason that the whole hype on Berlin is kind of based on the rental expectation, right? And that's kind of reflected in the pricing nowadays. So if you hit a 50% rental increase, they probably will all lose money in the next 5 years. If they hit 80%, then they will be on the money. And then if they double the rents, then they probably will sit there and, or I bet in Berlin, worked out. But I think there's a lot of rental increase already priced in. I mean, otherwise a Blackstone wouldn't go into a market and buy at sub 4% yields, even if they have a core plus vehicle. I mean, they have kind of an idea in their head, but the question is how far will that go?
You know, it's surprising what's happening there, and even our own valuation team, which is in that market, maybe way too long and maybe way too close, didn't expect that growth which is happening at the moment. And this is sheer. It's not only the startups which are going there. There are, which we know, also some searches in the market for R&D departments from automotive companies, which move their departments there where the talent is, because the talent doesn't want to move to Wolfsburg or to Rüsselsheim. It's a trend which is emerging. On the other hand, we've seen investments with a underwritten rental growth, and their business plan is even outperformed. just see the Potsdamer Platz, they underwrote it maybe for 25 and signing leases for 28 at the moment. That internal adjustments 2 years ago, we said, well, that's kind of brave. At the moment, the market tells us they did the right move in that time. It's a matter of scarcity. It's a matter of where else to go for those tenants. And you see that it's a matter of the low vacancy and the demand which is in the market, and that not much buildings have been built in the past. That's what we said earlier. The new supply is not really on the line. It's coming only now.
I've got a final question for everybody. So you need to tell us where we should all invest and why. We won't then vote on everybody's view. So just in terms of the market that we're looking at, the fundamentals that we're seeing, the risks that we've looked at, what does that lead you to believe for 2019? Where do you see the opportunities? You can be pan-European or you can be German. Karsten.
Well, it kind of depends on what you want, right? We deal a lot with value-add investors and opportunistic investors, and when it comes to that, you definitely need a detailed approach on the ground. I think right now what I would do is to invest in something that will carry me through whatever is going to happen in the next couple of years, right? So I don't want to be in the pressure to have to sell in 3 or 5 years' time. I should be able to carry on for the next 8 to 10 years, and taking alongside of that kind of the general trends at the moment. I still like my logistics industrial theme. I think that will only go in one direction, has been doing so in the UK as well. To a degree, I also still like the resi play in general, because I think there's quite a bit of room still, even though you're at a high level, but we had that discussion in a global context. On the European context, you're still at a fairly low level, right? So I quite like that. And well, we like secondary offices. You have to be selective. You don't run across the country. We have 80 cities with 100,000 people plus. You have to know what you're doing, but good secondary offices are probably, since we talked about the yield gap to government bonds, etc., it's probably also an interesting move to carry you through the cycle with a good cash-on-cash yield for the years to come. Yeah.
Okay, good. Daniel.
So for me, it's production of office, basically. If you look at the fundamentals, like there's record demand, there's record vacancy, there's increasing rents, and no one is building office. So basically, if you are able to redevelop existing office stock in good inner city locations, I guess that will be quite a good choice.
Okay, great. Markus.
Well, I was with Karsten until he said the secondary cities. That's I would not do. And then as well redevelopment in existing city centers, because there is stock growing old, locations are good, and a good refurb story should turn on that.
I'll stick with the office theme, but I would only invest in the main hubs. I think there are clearly some outperformers. We're not talking about countries, we're talking about cities here. And within these cities, on transport hubs of public transport, which are becoming increasingly important. I think in the network of a city, I mean with the Grand Paris project and other Crossrail in London, if you concentrate on the right locations in these outperforming cities, you will find outperforming property, independent of its profile, because you can always add value at the right rent levels. You can always reinvest and bring properties up to speed.
Competitor, I suppose.
We're trying to sometimes.
Karsten.
I would try to set up either office or resi brand, meaning that I don't necessarily need to invest into the stones itself, but to have a platform attracting tenants.
Okay.
And sell it basically as a brand, because I think that can be the real game changer.
Thank you.